The Super Bowl, the annual championship game of the National Football League, is not just a highly anticipated event for sports fans. As it turns out, the outcome of the game may also hold some predictive power when it comes to the stock market. This concept is known as the Super Bowl indicator, and it was first discovered by Leonard Kopit in 1978. And in this video, let's talk about how this concept works and some other stock market myth indicators that will blow your mind. So, the theory states that if a team from the National Football Conference wins the Super Bowl, the stock market will generally rise for the entire year. Meanwhile, the stock market will generally decline if a team from the American Football Conference wins. While this may sound far-fetched, there is some data to back it up. You see, between 1967 and 1994, the stock market went down by an average of 2.1% when an AFC team won the Super Bowl. On the other hand, the stock market went up by an average of 12.3% when an NFC team won the Super Bowl. This trend was so consistent that it was hard to ignore and became a popular topic among investors and market watchers. However, as more data has become available, this trend has not been as reliable. In fact, between 1995 and 2021, the stock market returned an average of 12.7% when an AFC team won the Super Bowl and an average of 17.2% when an NFC team won. This gap is closing over time, and it's not a guarantee that the market will move in a certain direction based on the outcome of the Super Bowl. Additionally, it's worth noting that there are other myths and indicators that investors use to gain an edge in the stock market besides the Super Bowl indicator. An example of this is the January effect. It's basically a financial market phenomenon that states that stock prices tend to rise during January. The theory behind this effect is that many investors sell losing stocks for tax reasons at the end of the calendar year. This causes prices to drop as supply exceeds demand. And when the new year starts, these investors then buy back these same stocks at lower prices, which causes prices to rise. Additionally, mutual funds and other institutional investors often make new investments at the start of the year, contributing to the upward movement in stock prices. Moreover, the January effect is not a guaranteed phenomenon, and it's not observed every year. Just like this January 2023, stocks fall in first trading day of 2023. Apple and Tesla sink. Tesla continued to downslide to start the new year, plunging 12.2%, its biggest one-day drop in more than 2 years. There are many factors that can affect the stock market, such as economic conditions and political and global events. For example, in 2008, the market was affected by the global financial crisis, and the January effect did not happen that year. Another example is the January effect of 2021, where the market was affected by the pandemic and the political transition. The pandemic also caused a lot of uncertainty, and the market dropped in January. However, the market started to recover, and the January effect happened again as the vaccine rollout and the stimulus package was implemented. Sell in May and go away is another myth investors use to predict the stock market. This stock market strategy suggests investors should sell their stocks in May and repurchase them in November to avoid the summer market downturns. This theory was popularized by American stock market analyst and historian Yale Hirsch. He first presented this strategy in the Stock Trader's Almanac in 1972. And he based it on the historical patterns of the stock market performance between May and October. His research was shown that there is a statistically significant pattern of the market underperforming during the summer months. The idea behind this strategy is that investors should take advantage of the historical market trend and sell their stocks in May when the market is thought to be at its peak, and then they should repurchase them in November when prices are thought to be at their lowest. Hirsch's research was shown that the average return for November through April is 10.4%. Meanwhile, the average return for May through October is only 5.0%. Now, before we continue, I'd like to thank you for getting this far. And if you want to learn more about these myths and the Super Bowl 57, then make sure to watch this next part. Now, Let's compare the US and international stock markets. It's important to note that the US and international markets are different and have different growth drivers. Therefore, these strategies may not apply to the international markets as it does to the US markets. International stock markets have their own economic conditions and political environments that can affect their performance, which may not correlate with the US market. Additionally, the market's correlation may also vary depending on the region. For example, markets in emerging countries may not show the same pattern as developed countries. Furthermore, the performance of the international markets can also be affected by currency fluctuations, trade relations, and geopolitical events. There's also another myth I want to tell you about. It's called the Santa Claus Rally. It is a stock market phenomenon that refers to the tendency for stock prices to rise during the last week of December and the first 2 trading days of January. The theory behind this phenomenon is that investors are in a festive mood during the holiday season and tend to be more optimistic about the stock market, which causes prices to rise. Additionally, some investors may also engage in window dressing, where they buy stocks at the end of the year to make their portfolio look better on their year-end statements. This theory is based on historical data showing a statistically significant market performance pattern during this period. However, it's important to note that, just like any other theory, it's still not a guaranteed way to make profits. It's because market conditions may vary each year, and there are many factors that influence the stock market and the economy, such as interest rates, GDP, inflation, and political events. Additionally, the Santa Claus Rally is more pronounced in small-cap stocks, which are stocks of smaller companies that are less well-known and less widely traded. Another important thing to note is that the stock market is a forward-looking indicator. This means it looks at the future prospects of the economy and the companies listed in it. The stock market's performance is based on investors' collective optimism or pessimism about the future. Therefore, it's not just the outcome of the Super Bowl that is considered while predicting the stock market, but also the overall economic conditions, the political environment, and the performance of companies. And as we approach the 2023 Super Bowl, it will be interesting to see if the Super Bowl indicator holds true. While the game's outcome may not directly impact the stock market, it will be worth watching to see if there is any correlation. You see, it's important for investors to base their decisions on sound research and analysis, rather than relying on superstitions or myths. Using the Super Bowl indicator as a sole basis for investment decisions is not advisable. Rather, it should be considered as a fun way to observe the correlation. It's always a good idea to diversify your investments. Do your research and consult with a financial advisor before making any investment decisions. So now, are you ready for the biggest game of the year? Super Bowl 57 is just around the corner, and it's sure to be an unforgettable experience. It will be on February 12, 2023, and the best teams in the NFL will battle it out for the coveted Vince Lombardi Trophy at the State Farm Stadium in Glendale, Arizona, which is the home of the Arizona Cardinals. This is the 4th time that Arizona will host the Super Bowl, and the excitement is palpable. But the game isn't the only thing to look forward to. The halftime show is always a highlight of the night, and this year's headliner is none other than Rihanna. It's sure to be an unforgettable performance that you won't want to miss. And if the price of the tickets are too much for you, Fox will be broadcasting the game, so you can catch all the plays, touchdowns, and celebrations from your home. So, what do you think of the Super Bowl indicator and the other stock market predicting theories? And are you excited for Super Bowl 57? Let me know in the comments section below. And while you're at it, make sure to smash the like and subscribe buttons as well. Now, if you want to know about the best investments during this volatile market, then make sure to click and watch this video right here and enjoy. And that's the end of this video, guys. See you next time.